You're listening to Booked, the bookstore education podcast brought to you by the American Booksellers Association. In this episode, we're presenting Bookkeeping 101, which was part 2 of the 3-part financial series presented virtually in 2021.
Okay, we're going to go ahead and get started. Thanks for joining the financial sessions that ABA started. This is part 2. We did part 1 during Winter Institute just last week. That was a Q1 check-in. Today, you're going to be hearing about Bookkeeping 101. And next Thursday, which is the 4th of March, we're going to be presenting Managerial Accounting. To register for that, you can go to the ABA events calendar at a glance and find the session on March 4th. If you click on that, the Zoom information to register for that will come up. Just a quick note that we are recording this session, so keep that in mind. And then just to do a few little housekeeping things before we start. Let's see here. So you can see the antitrust guidelines. We cannot talk about, we cannot have discussions about price or pricing policies. There can be no discussions of boycotts, and there can be no discussions of dividing up a market. And then I am sure at this point you are all familiar with Zoom, but just in case, we have some a picture here of the controls. So we have your mute button, which you can mute or unmute yourself. We ask you to stay on mute. Towards the end of this session, we'll be taking questions, at which point you can use the raise hand icon. Jennifer will call on you and you can ask your question, unmute yourself, ask your question, remute yourself. And then next to the audio, you have your video control. You can turn your picture on and off as you like. The participants icon will allow you to access the raised hand icon. And then finally, the chat icon, in case you want to drop something into the chat to discuss with your colleagues. Let me see, stop sharing my screen. Okay. So to introduce the panel, today we have PK Sindwani. PK is ABA's CFO. He's been the CFO for the last year. Previously to joining ABA, PK owned and operated a bookstore for 29 years, and he has a degree in accounting. Anna Gonzalez has celebrated her 11th year with ABA this month. Before coming to ABA, she worked in the for-profit industry in accounting. Jennifer Aldemovar has been with ABA for 4.5 years and has worked in nonprofit for 15 years. And then Anne-Marie Maggio is our billings and collections officer or person for ABA. She's been with ABA for over 8 years, and she previously worked in communication. So this is the ABA finance department. This is the team that manages ABA finance, and they're going to walk you through some important information on Bookkeeping 101. So at this point, I'd like to hand it over to PK. PK.
Thank you. Thank you for coming. So first, I want to set expectations for everybody, what we'll be going through today. We will stick with Bookkeeping 101. It will be extensive, but we'll just stick with 101 for this session. We'll define all the accounting terms for you, and we want to make a case for active financial management by building a framework. And then in the end, we'll give you all the tools to make good business decisions, all the way to financial statement. And I'll hand it to Jennifer now.
Oh, there we go. Hi. So before we begin, I want to thank Anna and Anne-Marie for joining us. And we have a lot to cover. I'm grateful for Anna's participation and Anne-Marie for sitting in for a little bit in today's workshop. So thank you. Okay, so I was just curious how many people here in this session today attended last week's session. If you can show your hands. Oh, quite a few. All right, well, thank you for joining us last time, and thank you for being here for this bookkeeping session. And let's begin. So bookkeeping is the process of recording every financial transaction that is later used in accounting to generate financial statements. And it also helps with business decisions. Accurate bookkeeping is therefore very important and allows for the efficient analysis of the business to take place. Some common bookkeeping transactions: recording payments from customers, sending invoices and recording payments that are received, entering bills, issuing payments for those bills, tracking employee payroll and payroll taxes, recording sales tax collected and payment that you'll there later on pay, recording inventory purchases and ending inventory, data entry such as depreciation, bad debt, write-off, etc. Also, some bookkeepers reconcile bank financial statements, but if they have access to online banking, that's not highly recommended. These functions are all to be recorded in your accounting software with a journal entry, which we will get into a little later. Before we can go into journal entries, there are a few things that you should have an understanding of, and that will bring us to the chart of accounts. This is a list of accounts which will help you organize all the financial transactions by the process of assigning a name and a number for anything that spends money or anything that brings you money. Your accounting software can usually guide you through this, and we also have a sample chart of accounts in the available downloads. And so for the chart of accounts, there are 5 different categories, and Anna will go into each of these categories for us.
Hello, everyone. Jennifer and BK. Hi, it is my pleasure to join you. Thanks for inviting me. Assets is category number 1. The asset category is where you keep track of what your company owns, beginning with the current asset. Current asset will include account for cash at hand, such as checking or savings account. An accounts receivable will record money owed to you, but not yet paid. You'll also need an inventory account. Of all the assets in your balance sheet, inventory account will most likely be the biggest in terms of value. Calculating ending inventory is very important because it is the number that will show on your financial statement. The equation to calculate ending inventory is beginning inventory, net purchases, minus cost of goods sold. This is usually calculated automatically by most POS systems. Fixed asset or capital purchase is something that you buy that is meant to last for more than a year, such as computer equipment, building, or property improvement. Category number 2 is liabilities. Liability is where you keep track of debt obligation or what is owed to you, what you owe in the immediate future. Current liability will include short-term debt account, such as accounts payable. It's the account where you're going to record what you owe to your suppliers. It would also include sales tax, short-term loans, interest, payroll taxes, and prepaid sales. Long-term liability debt will include anything that is owed over several years, such as long-term loan or mortgages. Owner's equity. Owner's equity account includes your investment in the business. You might also want to create an account for retained earnings for any profit that you put back into the store. Revenue. Revenue is your primary source of income. You want to create sub-accounts such as sales discount, sales return, and cost of goods sold. Or you might decide to record these as expenses instead of reducing your revenue line. Your revenue also might include interest income or any other income from a cafe or a bar if your store has one. The last category is expenses, which includes office expenses, travel, compensation, bank fees, consulting fees, and legal fees. Oh, Jennifer's frozen. We want to give her a few minutes.
Oh, okay. Yes, let's continue, Anna. And hopefully Jennifer will pick up where we left off.
Okay. I think I see the slide for the general ledger, which is Jennifer's part, but I will be pitching in until she comes on screen. General ledger is where you record all of transactions that take place during the life of the company, or you could call it your financial history book. A trial balance will show you account balance within a specific period where the total debits will equal the total credits recorded. Journal entry used to record financial transaction. Journal entry used to record financial transaction by assigning a debit and a credit value to an account within the chart of account. Debits and credits. We use debits and credits to balance each financial transaction. When you pay a bill or make a purchase, one account decreases in value, the other account increases in value. I believe we have a slide to show.
Please just wait 1 second while we get the slides back up.
Okay, so.
Sorry about the technical difficulties, hopefully. I do have slides. Let me see if I could share. But anyway, if you do have slides, Anna was on page 10, where we're talking about debits and credits that we use to for balance sheet transactions.
Which means that for every debit, there is going to be a credit to offset the debit.
So, for example, when you pay a bill or make a purchase, one account increases in value and the other account decreases in value. So, for example, if you make a purchase, expenses increase and your cash account, asset account decreases. And next slide is, so for any increase in assets increase in value, if assets increase in value, you debit it, and credit if assets decrease in value in assets is shown by crediting the asset account. And liabilities are quite the opposite. Increase in liability is a credit, but a decrease in liability is a debit. And I will go through some sample journal entry to so make sure this is more clear. Oh, okay, she's sharing that slide. That's fantastic. Okay. Go ahead.
Okay, what slide are you on?
I was on slide 10. That's where Anna was. And then, yep, we finished 10. Let's go over 11 again.
And we're getting ready for accruals and cash and accrual accounting.
Okay, so so assets increase. Any increase in assets is debit, and decrease in assets is a credit. Similarly, any increase in liability is shown as a credit, and a decrease in liability is a debit. And I'll go over it once again. I'll go over it in a minute. Similarly, equity is any increase in asset in equity is a credit. Any decrease in equity is a debit. Any increase in revenue is a credit. Any decrease in revenue is an expense. So so what I want to do is I want to go back. Can we go back to slide 2, Lisa? I just want to go over in bookstore terms what we mean by current assets and all that before I go to the last. Okay, can we go up slide more up, slide 2?
Oh, slide 2. Okay, hold on.
Yeah.
Sorry.
Sorry about that. I just want to put it in. Sorry, one more down. One more down. Yeah, down.
There it is.
Okay, so in cash in hand and assets account, what we mean is your POS system and your furniture, fixtures, everything that is an asset goes not in current assets, the long-term assets. The current assets are basically things that are fairly liquid, such as cash, or in our case, inventory is fairly liquid that we can just turn into cash pretty quick. And in liability, similarly, current liabilities are things that you owe right away. Short-term loan payables. So sometimes if you have a big loan that's paid over 10 years, anything that's due or any line of credit that is due within a year comes to the short-term loan payable. This tells you how much you owe right away. Prepaid sales, I wanted to explain that prepaid sales is your gift cards and also the new prepaid orders. And that's a big, there was a lot of questions about that in the last session. I had some emails about that. So until the day of the sale, what we should do is we should recognize all those people that pre-ordered books as a deposit instead of as a sale. And that way we can recognize the day of the sale, that we can recognize the revenue, which is what most publishers want us to do. I'm sorry, just okay. All right, just wanted to explain that, couple of things on that. And the next slide, sales. Can we go to the next slide, please? One more. The other thing, oh yes, sales revenue account. Now here we have combined it, but within the sales revenue, you will see in chart of accounts, there are so many sub accounts between book sales, non-book sales, cafe, bar. There are many sub accounts, but they're all combined into one sale revenue account here. Okay, now go to the next slide, please. Numbering system we went over. Next we went over that. Okay, debits and credits for balance sheet, we have gone over that. I'm going to go over, can we go into journal entry page, slide number 12? Okay, we have some sample entries to summarize what we just talked about. So for example, let's say you bought books from Ingram and you paid cash for it, or we paid by check. So basically you would debit inventory account and credit cash. In other words, your asset account called inventory will be increased. At the same time, your asset account called cash will be decreased. Now, this is like entering a check in your accounting system. When you enter a check in the accounting system, this is what it does. And similarly, if you bought, let's say if you buy inventory, you bought $1,000 worth of inventory from PRH, and this time you are not paying it right away, you bought it on account. This time your asset inventory is again increased by $1,000, and your account liability, accounts payable, is also increased. Sorry, can everybody hear me better? Your liability account has also been increased by 1,000. So in credit, liabilities increase in credit. This is like entering an invoice in your accounting system. Basically, when you enter an invoice, this is the entry it does. But within accounts payable, we call it a subsidiary ledger. It keeps track of how much you owe. Let's say if you bought another 1,000 from Hachette, it will keep track of it. That's basically, it's in general ledger, it gives you one number, how much you owe, but behind the scenes, accounts payable will keep track of how much you owe to who. Finally, selling. So for example, if you sold, next one, if you sold books to a corporation, local corporation, let's say they paid you $500 in cash. Out of that, 480 was revenue, another $20 was sales tax. Sales tax is one of those prepaid sales kind of account. It's a liability, you owe it, you just have it temporarily. So it's a liability account. By showing $20 in credit, you have increased your liability by $20. And by showing revenue, $480, you have shown it's a credit, meaning that you have gained $400 in sales. Next. So now let's say next week you have paid PRH. What you did is you decreased your liability by 1,000. So you will debit accounts payable and you will credit cash. In other words, your assets have been decreased by $1,000. At the same time, your liability has also been decreased by $1,000. And once again, this is like cutting a check on your accounts payable system in your accounting system, and accounts payable module keeps track of it behind the scenes. And same thing with prepaid sales tax. If let's say if you pay back the sales tax to the government, you have once again reduced your liability by $20 by paying the sales tax. At the same time, you have also reduced your cash by $20. Okay. One more thing before I go to next slide. And this was a question that came up with a lot last time as well. A difference between accrual and cash accounting. In this method, for our kind of businesses that use inventory, accrual is the best way to go. In accrual accounting, sales and expenses are recognized in the month they happen. In cash accounting, expenses and revenues are recognized in the month you actually get paid. So if you have, let's say if you sold $200 worth of books to a school, which paid you, you bought it in January, you sold it to school in February, but got paid in March. In cash accounting, you will have a loss in January. That's when you paid for the books, but gain in a profit in March. So you see you have a loss in one month, profit in other ones. You have to put 2 and 2 together to figure out how much you actually made. But in accrual accounting, both those transactions will be recorded in February. It's when the sale happened, regardless of when they got paid. That's when the transaction took place. You can easily see how much profit you make. So let's say if the books were sold for $200, you could see you made $100 in profit. I think I'm going to go over to the questions now, or before I show some other sample entries, let's talk about the questions. All right. And are you able to read the questions? Where are they? Sorry.
We're reading the prepare question or the questions that are coming in?
They're coming in. Are you able to read the questions in the chats first? Let's start with the chats. Are there any questions in the chat?
Yeah, there were questions in the chat. Let me just.
Okay, sorry. Find the hand.
Bear with me.
Okay.
I can jump in, Anna.
No, I think I got it.
Okay.
You want me to say who the question is coming from?
Yeah. Oh, there are a bunch of people that.
Yeah. My pre-order sales are paid in full upfront. I've been wondering how to count them in sales because technically the sales date has not occurred yet.
Yes. So a lot of POS systems are addressing these questions now. It's happening a lot more now that we're taking pre-orders. So what you do is you take the price of the book plus the sales tax and you record it as a deposit. I know I used to use IBIT, and IBIT does have a way of you to record that as a deposit. It matches the deposit with the person it's giving. So because you do not want to recognize the revenue for many reasons. One, somebody could ask for a refund if they think it's taking too long, or it really hasn't happened yet. So the day of the sale, the day of the online, and also New York Times ignores all the prepaid sales. So it's best to show it the way it's the day of the sale. So the day of the sale, you just acknowledge the deposit. So in other words, what you're doing is you are debiting cash, which is what you've received, and you're crediting your prepaid sales account. It's a liability account. In other words, the revenue is not yours until the date of the sale. And the date of the sale, when they pick up their books, you can then credit revenue and then debit deposits. In other words, previously you had credited deposits. Now you're going to debit deposits, and it will wash each other out, and the sale will be recognized on the day of the on sale date.
This question is from Jennifer Shima, and she's referring to one of the slides. In the sample journal entry, it seems like the columns are switched. Shouldn't inventory be credited and cash be debited?
Which slide?
It doesn't say which slide. So Jennifer Shima, if you want to unmute yourself and
it's slide 10, and thank you.
Thank you.
Slide 10. Okay. Are you talking about?
Nope, I'm sorry, I'm wrong. I got that wrong. It's 12, starting on 12, the sample journal entry slides. I apologize.
Okay, so if you bought books, so if you bought book from Ingram, you're basically increasing your inventory and decreasing cash. So that is correct. Inventory is debit and cash is credit. And similarly, if you bought it on terms from PRH, your inventory, in other words, your asset is going up, inventory asset, but at the same time, your liability is going up, which is a credit. So that is also correct. Can we go on the next slide?
PK, we don't have the slides up right now.
Oh, sorry.
Yeah.
Okay, so I'm reading it. The next slide is when you paid PRH, you are basically reducing your liability, and also since you paid cash, you're reducing your asset. I'm sorry, all these sample journal entries here seem correct.
Could you maybe help me understand then? Because when I think of increasing my inventory by $10,000 when I buy books from Ingram with cash, that doesn't seem like a debit. It would seem like a overall a positive, like a credit. Or maybe I'm understanding the words debit and credit incorrectly here.
You are correct. It is, you are gaining a value in your inventory assets. In other words, you have now $10,000 of books. So that asset has been increased by $10,000. But at the same time, you've paid cash. So therefore, you've lost $10,000 from your bank account. I shouldn't say lost. You've decreased the value of your cash by $10,000. therefore any decrease in asset is recognized as a credit. It's basically you've traded inventory for cash. Your value of inventory increased, but the value of cash went down. I hope that makes sense.
Thank you.
Okay.
Next question. Where do you think the best place to account for trade credit is? It goes into an explanation. Give me a minute. I give trade credits for used books, so we have to account for being cashed in as well. Account for outstanding balance of trade credit we owe. So Lacey Simmons, and she's confused about the process.
Okay, so I would definitely keep it separate, but think of trade credits as a gift card. In other words, you owe somebody that you giving them a credit is like you handing them a gift card to be used at any given time. You would recognize, just like your prepaid sales, just like your gift card, your trade credit card should be recognized as a liability called prepaid sales. In other words, you owe people that money. I hope that answers your question. Okay.
Can I just step in for a second to clarify? And then just to like, our accountant often struggles with this. We treat the redeemed trade credit as though it is a gift card. You know, we enter it in daily sales. But then the long-term sort of balance, like let's say at any given time, the trade credit people haven't used, they're usually unsure where that should go. And that maybe it has to do with it's unclear when it will be used.
Yes, so basically it's like you keep your prepaid balance. In other words, it's no different than your gift card. Let's say you sold $1,000 worth of gift cards in the month of February. You don't know when they will be used. Let's say $100 of that is used in March. So next time your prepaid sales amount will be 900. You are basically debiting prepaid sales. In other words, reducing prepaid sales, and you are crediting revenue. At that point, you're basically recognizing an income, but at the same time, you're not recognizing what hasn't happened yet. So anytime you redeem it, you're basically just taking it out of the same prepaid sales account that you entered in, just basically reversing everything you did the month before. Except this time, instead of cash, you're crediting sales. I hope that made sense, but I'm happy to chat after the session. If you want to email me, I'm happy to explain further.
Okay, thank you, Kay.
You're welcome, Lacey.
I don't see any more question in the chat. If anybody else has a question, or we could move on to the prepared questions we had.
Okay, yes. Anna, do you have the questions that we got before?
Yes, I do.
Okay.
What is a purchase order or a PO?
Oh, that's a good question. That's a purchase order is a promise to buy something. So for example, if you're sending Ingram a purchase order, meaning you are asking Ingram to send you those books. At this point, it's just a commitment, and you can show it. That will be in the next session. You can show it how much of the cash you are going to anticipate blocking for that PO. But as far as bookkeeping is concerned, it does not get recognized until you actually get the books. The day you get the books that's when you recognize how much of that you got. In many cases, you could send a PO for $1,000 to Ingram, but they don't have all the books, or some of them are on back order. So 800 will come this month, and then maybe another 200 out of that 100 will be canceled, or another 100 next month. So you will recognize part of the PO as it comes in as an increased value in the inventory. Okay.
Next question. Should I have a personal account and a business account, or combine them?
Oh, definitely have two separate accounts. You never want to mix personal checking with your business checking. As a matter of fact, there's a thing called GAAP, Generally Accepted Accounting Principles. And one of the things that's what we use in the country. It just assumes that you are keeping your business and personal expenses separate. So it will be hard to prove IRS that, this is a person. I mean, you could do it, but it will be very messy and not clean. So it's best to have two separate accounts.
When do you capitalize rather than expense a purchase?
Any purchase that anything that you buy, say something like computer, that you needed to buy a computer, anything that lasts over a year, that usually is capitalized. Things that will last, your computer system. Let's say you had to buy a table or fixtures, or you had to make an improvement in your store, anything that's long-term. So different assets have different useful life. For example, typically computers have a 5 years useful life. So you take a computer and you put it in as a capital expense. It's an asset you added. But if you spend $1,000 on it and the useful life is 5 years, you only get to expense $200 per month, per year, sorry, for the next 5 years. So on your tax returns, your assets after the end of 1 year are now worth $800, because even though you spent $1,000, 200 of that has been depreciated, and so on and so forth. So anything that has a useful life of 1 or more year should be capitalized.
Hey, Anna, let's go back to the questions in the chat. Looks like we have another one.
Okay. Charity McMaster, and I'm sorry if I'm mispronouncing your name. She seems to be confused about slide number 12, the sample journal entry.
Okay, let's see. Slide number 12. Okay. Can you come on the microphone? Which part is confusing? I'm sorry.
I think I'm misunderstanding the definition of credit and debit. In that example, there are two things that we bought, and so we're increasing our inventory, but it's going in the debit, which I think of as decrease. And then there's also one thing that we sold, so there's two bought and one sold, but those are all in that debit column, and that's where I'm getting confused.
Okay, so I think you are getting confused between assets, liabilities, and revenue and expense. So assets and liabilities are what is reflected, like how much an organization owe that it can cash out. In other words, how much cash you have, how much inventory you have, how much other assets are worth. So those are assets. Now, increase in assets is always shown with debit, is recognized by debit. But at the same time, any expense or a loss is also a debit. It is a little bit confusing. A debit in profit and loss means the value is going, your profit is going down in a debit in P&L income statement, but at the same time, a debit in balance sheet is basically making the value of your organization higher. When you bought, in this case, bought Ingram inventory, you're increasing your assets inventory by $10,000, but at the same time, your net effect on balance sheet is zero because you paid cash. So one asset went up and the other asset went down. So the net bottom line value on the balance sheet is no effect. But at the same time, if all of that inventory was used, this is until the inventory is used. If all of that inventory was used, then it will be an expense. Then again, you will take that inventory out of this debit category, you would credit that, and you would increase your expenses by showing it a debit. So yes, it is a little bit confusing, but yes, the expenses are a debit in profit and loss statement. I hope that makes sense.
It does help. Thank you.
And I can go over a few more entries if we have time. And is there any other question?
I don't see any other question, Lisa, do you?
Oh, the ones we got before? Do you have any?
No, yes, I have more of those.
Okay.
It's just, so how often can I switch accounting methods?
Oh, that's really a good question. You cannot, so you can switch every year if you want to, but you have to file a form, and I believe it's called 3315. So you can't decide retroactively that you could switch. And that is a question I got in a couple of times in the email as well. IRS will only allow you to switch if you decide within a year. And this happened a lot in the pandemic. A lot of people got extra dating during the pandemic. If they had cash accounting before, but this year they didn't have to pay for it. They all of a sudden they realize that they don't have any expenses because they didn't pay for the inventory till 2021. Unfortunately, IRS will not allow you to come back in 2021 and say, hey, can I change my accounting method in 2020? No, you have to declare every year if you are going to change. If you don't change, you don't have to do anything. But if you do change, you have to declare, you have to fill that form in. Okay, I have a comment from Jen.
Yeah, Jennifer's in the chat. She's trying to clarify a little more about the balance sheets and the assets and the liability versus the profit and loss statement.
Go ahead. Do you
Jennifer.
want to go? Okay, I can read that. Balance sheet will only show assets and liabilities, and equity, profit and loss will show revenue and expense. So I hope that makes sense. In once again, anything that you do not have a value anymore or has been used up, it's shown in income statement, or you can also call it profit and loss statement. And anything that still has a value, or anything that you owe, or is a liability to you, or is an equity that you have in the business, is in balance sheet as well. Okay. Go ahead. Next question, Anna.
What is the difference between deferred revenue and accounts receivable?
Oh, wow, that's a good question. Deferred revenue. What I'm trying to think, will be the difference. Accounts receivable is okay. It's the timings. Yes, it is the timing. So, for example, somebody has paid you in advance, but for a event, the ticket, you sold the ticket in advance, and that event is not going to happen till March. That money for the ticket again is a deferred revenue. It will be a revenue next month, but this year is just a deferred revenue. And accounts receivable, you've already sent the books. The things have already happened. Let's say if you sold the books to the school, they've already received the books, that becomes your accounts receivable. But the deferred revenue is you've got the money, but for something that will happen future down the road. Just similarly to selling books on a pre-order. It's basically the revenue will be recognized on the date of the pre-sale, on date of the sale, but up until that time, it's a pre-sale and people can back out. In accounts receivable, they've already received the product, so they owe you that money. In deferred revenue, they can change their mind up until the time it's recognized.
How often should I reconcile?
You should reconcile every month. You should recognize, banks should be reconciled every month. God forbid if there's any fraud, sometimes if it takes too long for you to recognize that, or if there is any mistakes, everything should be we should be reconciling every month. Similarly, all the prepaid expense, all the accrued liabilities. Accrued liability is something like, for example, you owe money for your electricity invoice came in the month of December, but you don't pay for it in January. So therefore you owe that until the you owe that. You will know that in January you owe invoice for the month of December. Up until that time, that amount is accrued expense. So you should be reconciling all your assets and liabilities account every month. It sounds a lot, but it is not. And Anna knows she does that every month.
Absolutely, and that would also avoid, or better yet, catching any mistakes that were made. So it is important to reconcile just to avoid keeping track of everything you have, obviously with your backup, and also correcting any mistakes and having all of your transaction journalized.
So we have 9 minutes left in the session. Anna and PK, Jennifer, I just wanted to check in with the audience if there are any more questions from the audience. Looks like we have one in the chat. Are there any others?
Yeah, so if there are no questions, I do have some more things that I would love to go over.
It looks like we do have one question in the chat. It looks like, PK.
Okay, go ahead.
Anna, do you want to speak that?
If I operate out of my home, what percentage of operation expenses do we use in terms of mortgage payment, electricity, or any other expenses incur?
Wow, that is a good tax accountant question. But the simple answer is, let's say you use one room out of a total house. Let's say if your house is worth is 1,000 square feet, but one room is of 100 square feet is totally dedicated to that. Then 10% of your electricity, 10% of your expenses, 10% of everything will be used as a business expense. Now, remember, there are a few things. IRS is pretty strict about that. You can, that one room, if you have it allocated as an office, you literally cannot use it any other time. You have to use that for any other thing. You have to use that room as an office. Literally, you can't go back and put a cot in there and sleep at night because you have allocated that as an office expense. And when I also say mortgage, not the whole mortgage. Mortgage is broken into an interest and a principal. So you can only deduct, so the principal is basically reducing your liability in the house and is ultimately going to you. You can only deduct 10% of the interest, not the equity, not the whole mortgage, just the interest portion of that. And anything else that 10% of all those expenses are considered office expense. There any more questions? No?
Thank you, PK. That was really helpful.
Okay, I do want to go, if there are any more questions, please?
Not in the chat. If anybody has a question, you could unmute yourself and ask your question if you like.
Okay, I just want to go over.
PK,
go ahead.
Sorry, actually, I do have a question.
Go ahead, Roy.
Sorry, this is Roy. I just put it in the chat. So I was looking at the general ledger, your model that you shared, the spreadsheet. I see you list like sales to the general public and other kind of sales daily. Could you do that less frequently, particularly if like thinking of like a bookshop site? I mean, I don't transfer the funds daily. Could I just list it on the day that I transfer the funds, like weekly or even monthly?
Yes.
I'm just small and new, but
yes, you could do. You
So-
could do it once a month.
Okay.
And the reason you could do it once a month. The reason I would say daily is, let's say 2 years down the road, you want to make some intelligent decisions. How many people I used to make decisions based on my historical sales. So for example, if Monday is your slowest day, well, you want to keep less people on that day. So that's why, if your point of sales is pretty good about giving you a historical data, even though it sounds like a lot of work, Roy, I would recognize that every day, because trust me, a year down the road, when you get a little more business, you'll be making decisions how many people to have that day. This data will be helpful. Obviously you want to have less people on Monday, or maybe on the other hand, Monday is when you get all your shipments. Maybe you do want to have less sales but more shipments. So those historical data, which days, what happens, they come in handy down the road. From accounting standpoint of view, you can enter it once a year when you're doing your tax return, but reconciliation becomes hard. To use that data becomes harder and harder the more you wait. So the best thing is to do it every day. Okay. Any more questions? So that's just, if you all have a handout that we send in there, where I just kind of showed how important bookkeeping is to your organization, how garbage in, garbage out, how everything flows from journal entry, which a bookkeeper enters in your accounting system, gets all the way transferred to your financial statements. So for example, let's say you put in first journal entry, you put in $60,000 when you started your business, you put in your cash, all of a sudden your asset cash increased by $60,000, and so did your stake in the organization increase by $60,000. Similarly, if you bought fixtures for $50,000, your assets, your long-term assets increased by $50,000, but at the same time, your short-term assets decreased by $50,000. Similarly, with inventory, when we went over sales, when you recognize the sales, if you recognized it, if you got cash for that sales, you debit cash and you credit the sales account. In other words, you're recognizing a revenue. That similarly, all those transactions that you did one by one, then go back, then get transferred to a document called journal ledger, which is a detailed summary of everything you did, everything your bookkeeper did throughout the month. And then it gets transferred to a document called trial balance, which is nothing similar to journal ledger, except in trial balance, you don't get the details, you just get the total debits and the total credits. And we use double entry system. So every step of the way, your debits should match your credit. And so you can tell that you have balance. And then similarly from that trial balance, the portion that are your assets or the liabilities then get transferred to your balance sheet. And the portion that is your income and expense then get transferred to your profit and loss. And all of that is an accrual-based accounting, which has nothing to do with cash. And then the final document is cash flow statement, which then tells you what's the real deal. How much cash do you have? How much did you spend? How much do you have left over? So those three financial statements, income, balance sheet, income statement, and cash flow statement, we will go over next Thursday on March 4th. But I just wanted to show in this handout how everything, how important the bookkeeping function is and how it flows all the way to balance sheets and
Thank
profit
you,
and loss.
PK, and finance staff. That was wonderful. So thank you everybody for attending. I think we are at our time. If you have further questions on this, I'm sure PK would be interested and willing to have them. His email is pk@bookweb.org. And hopefully we will see you all next week.
Yes, thank you so much. And yes, please feel free to email me. Thank you, Anna. Thank
You're
you,
welcome,
Jennifer.
PK.
Thank you. Apologize for my internet connections, but thank you for holding the fort down.
Thank you, everyone, for
Thank you,
joining
everyone,
us.
for joining.
Bye-bye.
Thank you for listening to Booked, the bookstore education podcast brought to you by the American Booksellers Association. Don't forget to subscribe to the show on your favorite podcast app. Additional educational resources can always be found on the ABA website at www.bookweb.org. Happy reading!